Dave worked 34 years at the same manufacturing company, contributed to his 401k every single paycheck, never missed a year, never raided it for a vacation, a car, a kitchen renovation, did everything the brochure said, retired at 67 with $920,000, felt like a winner. 18 months later, Dave called his accountant in a panic. His tax bill was higher than it had ever been while he was working. Linda spent 30 years as a nurse, maxed her 403B every year she could, took the company match, reinvested the dividends, accumulated $680,000 by 62. Felt proud, felt prepared. Then Medicare sent her a letter explaining her premiums were going up because her income, the income she thought she'd deferred, now counted against her. Then there's Tom, self-employed since his late 30s, put everything into a traditional IRA, never touched it. At 73, the IRS sent him a letter that wasn't a request. It was a schedule. You will withdraw this amount on this date whether you need the money or not, and you will pay ordinary income tax on every dollar. What's the pattern? They all believed the same lie, the lie that says defer your taxes now, pay less later. Here's the thing, for millions of people, that math is completely catastrophically backwards. My name is Nico, and I spend way too much time reading tax code nobody asked me to read. If you're someone who's been faithfully contributing to a 401k for decades and you've never had a single conversation about what happens when you actually take the money out, subscribe and like this video. It will help more than you think. Here's what we're actually doing today. I'm going to show you the hidden tax architecture built into traditional retirement accounts. We'll break down exactly who wins and who loses under the current rules. I'll explain the 3 specific traps that catch people who did everything right. And most importantly, I'll walk you through the actual moves that change the outcome, not just for people starting out, but for people already deep into accumulation. This isn't about motivation. It's about the actual mechanical systems that either give you freedom or create a new prison with better furniture. By the way, I built a free retirement tax exposure calculator because most online ones pretend taxes don't exist after age 65. This one uses Vanguard and BlackRock's modeling logic to estimate your real after-tax retirement income, factoring in RMDs, Social Security taxation thresholds, and Medicare surcharges. I only ask for your email to send the report. I don't store any of your financial data. Link is in the description. Think of your 401k like a storage unit you've been renting for 30 years. Every month you put more stuff inside. Every year the storage company says, "Great job, keep filling it up." What they don't mention is that on a specific date, the date you turn 73, they get to walk in, look around, and hand you a bill based on everything in there. And the more successful you were at filling it, the bigger that bill is going to be. That storage unit is your traditional 401k, and the bill is called a required minimum distribution. Here's what that actually means. Starting at age 73, the IRS legally requires you to withdraw a percentage of your traditional retirement accounts every single year, whether you need the money or not. You pay ordinary income tax on every dollar. Not capital gains rates, ordinary income, the same rate you paid when you were working. Here's where it gets interesting. In 1978, Congress passed the Revenue Act. One provision, Section 401k, added almost by accident after a benefits consultant named Ted Benna noticed a loophole in the language, became the foundation for the entire modern retirement savings system. It was originally designed as a tax deferral vehicle for corporate executives, something to let high earners smooth their income across time. It was never intended to be the primary retirement savings mechanism for 60 million American workers. But here we are. And because it was built for executives, the trap at the end is sized for executives too. Let me show you the math. Take Dave, $920,000 in a traditional 401k at 67. Social Security kicks in at $28,000 a year. His fixed expenses, mortgage paid off, modest lifestyle, run about $52,000 a year. On the surface, he's fine. He needs about $24,000 extra from his portfolio, which is well under 3% withdrawal. Textbook safe. But Dave didn't account for 3 things. First, his RMDs. At 73, based on the IRS life expectancy tables, Dave is required to withdraw roughly $36,000 that year from his accounts. He doesn't need $36,000. He needed $24,000, but he has to take it anyway. Here's the kicker. That $36,000 added to his $28,000 Social Security pushes his total income to $64,000. At that income level, 85% of his Social Security benefit becomes taxable. And here's what most people miss. It also pushes him into the IRMAA surcharge bracket. That's the Medicare income-related monthly adjustment amount, which means his Medicare Part B and Part D premiums jump by several $100s a month. Dave didn't make a mistake. Dave followed every rule on the brochure, but the brochure left out pages 4 through 12. Now let's run the same scenario for someone who made one different decision 20 years earlier. Same age, same income, same job. Meet Carol. Carol talked to a fee-only financial planner at 47, not an advisor at a bank, a fee-only planner who charged her flat for the conversation and had no products to sell. The planner showed her something called a Roth conversion ladder. Here's what that actually means. You take money from your traditional account, pay tax on it now at your current rate, and move it into a Roth IRA. The Roth grows tax-free. Withdrawals in retirement are tax-free. And here's the part nobody tells you. Roth accounts have no RMDs. The IRS cannot force you to take money from a Roth, ever. Carol spent the years between 47 and 62 during some low-income years when her kids left home and she dropped to part-time, converting chunks of her traditional IRA into a Roth. She paid taxes on those conversions at the 12% and 22% brackets. She did it systematically, not all at once, just enough each year to fill the brackets without pushing into the next one. At 73, Carol has $340,000 in a traditional account and $590,000 in a Roth. Her RMD is roughly $13,000. Her Social Security plus that $13,000 keeps her comfortably under the threshold where her benefits get taxed. Her Medicare premiums don't spike. She can pull from the Roth for anything extra, tax-free, whenever she wants. She has optionality. The second guy didn't have more money. He had optionality. Same starting conditions, same career, same contribution habits, different outcome, entirely because Carol knew which game she was playing. Imagine a retirement planning seminar from 1995. Guy in a suit, hair gel, overhead projector. Just defer, defer, defer. You'll be in a lower tax bracket in retirement. Now imagine that same guy in 2026, slightly older, same PowerPoint, Comic Sans still intact. So, about the lower tax bracket in retirement thing. Turns out if you saved successfully, you might actually be in a higher bracket. And if you have Social Security plus RMDs plus any investment income, 85% of your benefits could be taxable. Also, we didn't really account for Medicare surcharges, but other than that, great plan. The audience is Dave. Dave is not laughing. Here's the psychological trap underneath all of this, and it's not unique to retirement accounts. It's called deferred pain bias. The human brain is genuinely bad at weighing a small cost today against a large cost in 30 years. The 401k contribution feels like winning because you get a tax break this April. The RMD feels like an ambush because it arrives decades later in a tax environment you can't control. The financial industry built an entire product line around this bias, and the product benefits the financial industry, the IRS, and you, roughly in that order. The 401k is still a powerful tool. I'm not telling you to stop contributing. I'm telling you to understand the back half of the machine, not just the front. So here's what to actually do. Action step 1. This week, log into your retirement accounts and calculate the ratio of your traditional to Roth balances. If more than 70% of your retirement savings is in traditional accounts, you have tax concentration risk. That's not a reason to panic, it's a reason to plan. Action step 2. If you're in a low income year, career transition, part-time work, early retirement before Social Security kicks in, that is your conversion window. Talk to a fee-only CPA, not a product-selling advisor, about how much you can convert this year without pushing into the next bracket. The 12% bracket in 2026 runs to roughly $47,000 for single filers, $94,000 for married filing jointly. That's your conversion ceiling to work within. Action step 3. If you're under 50, make Roth contributions your default unless your employer match only applies to traditional. The math almost always favors Roth at lower income levels, and you're buying tax-free optionality that compounds for decades. 1. The tax break on 401k contributions isn't free money. It's a loan from the IRS with a 30-year variable rate repayment schedule you don't control. 2. The most powerful move isn't how much you save, it's which account type you save it in and when you convert it. 3. The people who get crushed in retirement aren't the ones who saved too little. They're the ones who saved in all the wrong buckets and never looked inside. If you want to see exactly how I think about the Roth conversion math for different income levels, there's a video on this channel that breaks it down year by year. Real numbers, no affiliate links, just math. Drop a comment and tell me if you think the 401k was always a tax trap by design, or if I'm just connecting dots that don't exist. I read them all. Don't be Dave. Lazy investing built more fortune than crypto memes.